Hello, I'm Ron Wilson. In this month's news, in the 2017-18 federal budget, the government has proposed a number of new financial services rules, including a levy on Australia's 5 largest banks and mandatory membership for all AFS licensees with a new Australian Financial Complaints Authority. The use of limited recourse borrowing arrangements will now count towards an individual's total superannuation balance and transfer balance cap. Those aged over 65 who sell a family home will be able to contribute an additional $300,000 to their superannuation balance over and above the current $1.6 million contribution limit. And in international news, Chinese GDP growth grew at 6.9%, eclipsing market expectations. Michael Pollock has the details.
From the 1st of July 2017, a new 6 basis point levy will be imposed upon the biggest 5 Australian banks who have more than $100 billion in liabilities. The levy will apply to bank certificates of deposit, commercial paper, corporate bonds and Tier 2 capital instruments. On the 1st of July 2018, the Australian Financial Complaints Authority, or AFCA, will replace the current external dispute resolution bodies, the Financial Ombudsman Service, the Credit and Investment Ombudsman, as well as the Superannuation Complaints Tribunal, as a one-stop shop for all financial and superannuation dispute resolution. All AFS licensees will be required to be members of AFCA, which will be able to hear consumer and investor disputes of greater value than the caps currently imposed on industry complaints schemes. From the 1st of July 2017, deductions for travel expenses related to inspecting, maintaining or collecting rent from a residential rental property will be disallowed. However, expenses incurred by investors who engage a third party, such as a real estate agent for property management services, will remain deductible. From the 1st of January 2018, the CGT discount will be raised from 50% to 60% for resident individuals who elect to invest in qualifying affordable housing. To qualify for the higher CGT discount, a number of conditions must be satisfied. As anticipated, effective from the 1st of July 2017, the use of limited recourse borrowing arrangements, or LRBAs, will be counted towards an individual's total superannuation balance, or TSB, and their $1.6 million transfer balance cap. Not only will the outstanding balance of an LRBA be included in a member's annual TSB, any repayments of principal and interest of an LRBA from a member's accumulation account will be a credit in a member's transfer balance account. A new First Home Superannuation Saver Scheme is being introduced from the 1st of July 2017. This scheme will allow individuals to withdraw voluntary contributions of up to $15,000 per annum from the 1st of July 2018 and $30,000 in total, plus the associated earnings from their superannuation account for the purpose of a first home deposit. The concessional contributions and associated earnings will be taxed at 15% in the fund, and when withdrawn for this purpose will be taxed at the individual's marginal rate less a 30% offset. Also from the 1st of July 2018, people aged 65 and over will be able to inject up to $300,000 into superannuation as an NCC using the sale proceeds of the principal home. The NCCs will be in addition to the standard annual cap and can be made regardless of an individual's age or working status. However, the home must have been their principal residence for at least 10 years. Such contributions will also be exempt from the $1.6 million TSB test, which otherwise prevents additional NCCs, but they are not exempt from the $1.6 million transfer balance cap. The annual headline inflation rate rose 0.5% in the March quarter for an annual rate of 2.1%, up from 1.5% in the previous 3-month period, which means it is now inside the RBA's 2 to 3% target band for the first time in over 2 years. Core inflation measures, while still subdued, rose by an average quarterly rate of 0.4% to produce an annual rise of 1.8%, and so nearing the RBA's target. The RBA kept the cash rate at 1.5% at its May meeting. RBA Governor Philip Lowe signalled that the bank was closely watching developments in the housing sector, while also delivering a balanced assessment of the local and global economy. US real GDP increased at only 0.7% annualised for Q1 2017, compared with the 2.1% gain in Q4 of 2016. The considerably weaker recorded growth was primarily due to slower growth in consumer spending, which fell from a 3.5% gain in Q4 of 2016 to just 0.3% in the recent March quarter. This was the slowest rate of growth in consumer spending since 2009. However, on a much more positive note, business fixed investment, a critical component for the longer-term health of the economy, posted strong quarter growth of 9.4%, boding well for coming quarters. The housing market also had a strong start to the year. Despite weaker first quarter growth, the US Federal Reserve in its early May meeting announced no changes in policy. The accompanying policy statement acknowledged but also downplayed the slowing in economic growth. China's economy grew at a rate of 6.9% in the March quarter, the third successive quarterly improvement and just over the government's 6.5% target for the year. This was also slightly better than market expectations for steady growth of 6.8% and the fastest rate of expansion since the 2015 September quarter. The ECB Governing Council made no changes to its key interest rates or bond buying program in its late April meeting. The Council also confirmed that the net asset purchases at the new monthly pace of €60 billion, down from €80 billion previously, was intended to run until the end of December 2017 or beyond if necessary. ECB President Mario Draghi indicated that with little inflationary pressure, it was too early to consider reductions in its stimulus program, even though the euro area economic recovery is more solid and broad than it has been for some time.